Hey everyone, welcome back to the channel. Adrian here. Residential or commercial? In this video, I'm going to help you decide which real estate asset type to invest in. We're going to differentiate both asset types using 5 different categories. Stick around to the end because I'm going to explain how one category makes one asset type make more money than the other. So let's get started with the first category. The obvious one is going to be the number of units. Residential properties are between 1 to 4 units. Yes, lenders will allow you to get a home loan for up to 4 units. 5 units and over will be considered a commercial loan.
Oh, snap!
Aside from that, anything that is not residential is commercial. So home office, mobile home parks, and storage units are some of examples of commercial properties. Let's move on to the next category, which is how both asset types are valued. This is arguably the most important category because as investors, we're always trying to create value and then converting that value into capital. For residential properties, their value is based on what similar properties were sold for. The industry term is comparables or comps for short. In order to qualify as a comp, comps have to be in the same neighborhood and must have the same characteristics as the house being valued. It's very easy to get a comp if all of the houses in the street look the same. Now let's move on to commercial properties. There are 4 different ways to value a commercial property, namely sales comps, capitalization rate, income multiplier, and the replacement cost. Let's start with sales comps. The analysis is similar to residential properties, but instead we use a dollar per square foot to compare the properties. This method is useful for office space or vacant land. Let's move on to the capitalization rate. This is the preferred method when valuing a multifamily property. Now, I already made an in-depth video on cap rates. Links will be in the description below. But to simply explain it, cap rates are similar to the bond market. Because like bonds, where it is quoted by its yield in relation to the risk, cap rates are a measure of what investors are willing to pay for an income stream related to the risk. And like a bond, there is an inverse relationship between the yield and price. So a high cap rate means a low price for every income dollar, and a low cap rate means a high price for every income dollar. This is the formula to find the cap rate. Cap rate equals stabilized net operating income divided by the price or value. So if cap rates use a percentage to determine a property's value, the next method uses a multiplier. The income multiplier is actually the inverse of a cap rate because to find the multiplier, it is income multiplier equals the price or value divided by the stabilized net operating income. It is expressed as 20x or 15x. So to find the value of a property, all you have to do is multiply the stabilized net operating income with the income multiplier. Let's use a quick example to illustrate this. Using the cap rate method, if a property has a stabilized NOI of 2.5 million, in a 5 cap market, it would be worth $50 million. Now, using the income multiplier method, if a similar property traded at a 20x, then a property producing 2.5 million in NOI would be worth also $50 million. In other words, a 5 cap is equivalent to a 20x income multiplier. And the last method for valuing a commercial property is using the replacement cost. As the name implies, it is valuing a property based on how much it would take to acquire the land and construct the exact same property today. This method is commonly used for development projects. Let's move on to category 3. The next category is individuals or teams. You can operate a residential property as an individual or with a team. You can flip or manage your property by yourself if you want to, or hire a crew. If you enjoy doing the flips yourself and getting dirty, you can do that too. But for commercial properties, you must run it with a team. In other words, you're running a business and it so happened the product is real estate. That means you have to delegate the tasks to others so you can focus on growing the business. That said, there are more people that can influence the decision-making process. The next category is timelines. Everything is just longer with commercial properties. It may only take 30 to 45 days to close on a residential home, but it is 75 to 90 days to close on a commercial property. Because of the size, it also takes longer to inspect and rehab a commercial property. Most importantly, under timeline, it is the exit strategy. You can flip a property under a year, but it will take on average 3 to 5 years to flip a commercial property. And a lot of things can happen in the span of 3 years. While we're on the topic of exit strategy, you can sell a residential property to a real estate investor or to a family who will be using the property as their primary residence. But for commercial real estate, every buyer is an investor. That means they will be looking at the property purely as an investment standpoint. All right, let's move on to the last category. This is the category I mentioned that makes one earn more than the other, and that is tax benefits. This is true for those who flip residential properties. Now, commercial real estate still pays capital gains tax when it is sold, but this is lower than the personal tax income. There are also tax credits such as LIHTC and NMTC that helps commercial real estate investors keep more money. So let's go back to the big question. Should you invest in residential or commercial properties? Look, if you put the best flipper versus the best operator or general partner and see who makes the most money, the commercial investor will win by a huge margin. But is making the most money better? Is it better considering you have to work with a lot more people, raise the capital, and answer to investors? So the real answer is it depends on the individual. To become a great general partner, you would have to become a certain type of person to be successful at it. So first define what is your better and then choose. Allow me to slide in another alternative because this doesn't have to be an either or. You can also start investing in residential first before going into commercial. As I mentioned earlier, the payout of commercial can be a while and you still need to pay the bills or put food on the table.
Okay, dig in.
That's not a bad thing because some of the skills and knowledge you learn in residential can be applied into commercial property investing. And one of them is knowing how to increase a very popular metric that is present in both asset types. That is the cash on cash return. So check this video next where I go over how to use cash on cash return in commercial real estate.